Investors, since we exited the COVID lockdown, investors have been treated to a continuation of the bull market that began somewhere between 2010 and 2012, depending on your definition. As of this writing, the cash S&P 500 sits around 6850, which is up about 16.5% year to date. That said, it hasn't been easy to stay a bull and to stay positive and long biased the last 5 years. Over the last 5 years, an investor had to endure minus 27.5% peak to trough decline in 2022, including a near 10% inflation reading that year. That's minus 37.5% in purchasing power declines. In addition to the 2022 earnings decline and recession, investors had to recently weather a minus 21% decline in April of 2025 around the Trump tariff tantrum. Longer-term investors know that if you invest long enough, you will likely endure unrealized losses and downside volatility of varied sizes each and every year if you're invested in the S&P 500 or any other index. The reward for investing in equities is its return. The risk is enduring the downside volatility at times. Here's that great data from Charlie Biello on annual drawdowns and their frequency. Investors, look at the above chart. Minus 5% declines in the S&P 500 happens nearly every year, while a minus 10% decline happens every 18 months. The dreaded bear market decline of minus 20% happens a little over once every 4 years, while a recessionary decline of 30% happens 1 out of 10 years. Investors, if you invest long enough, expect at some point during your lifetime, the S&P 500 will lose half its value. Given its rarity, I'm going to call this one a generational decline. Investors, with this in mind, it brings me to this week's topic, our Oak Harvest first half 2026 market outlook, or at least a sneak peek. We've been doing these forecasts for over 5 years now at Oak Harvest. Our goal in this exercise is not to be precisely accurate, although many of our market forecasts have historically been both pretty accurate as well as precise, but it's to give our clients and prospects an idea of what issues, as well as what opportunities the Oak Harvest investment team thinks might be coming in the year ahead. As we've discussed in the past, there are times when tactically the investing odds favor going faster and investing more. And there are other times, like going into 2020, that it was time to curb your enthusiasm and proceed more cautiously. Investors, historically, there are certain economic and market setups that have higher odds of replaying similar past outcomes with higher frequencies. Some years, say like 2017, the bull strolls out of the gate and your ride is over in 8 seconds. An investor looks back at the end of the year and looks at their portfolio, and it looks like nothing eventful happened and there was little to no volatility. However, more frequently, like 2025, an investor will look back and see that at least 1 or 2 bouts of major downside volatility. Most years, even in strong bull markets, the bull tries to buck investors off its back and onto the ground. Those investors who don't have a steady hand, or retirees without an advisor or a coach, or at least a strong financial plan, can get swayed emotionally by swift increases in market volatility throughout the year. Investors, for the first half of 2026, our investment team is thinking that the tailwinds for the current bull market do extend themselves, and the pluses outweigh the negatives. However, the likelihood for higher sustained market volatility exists, and we do not expect it to be a smooth ride in the first half of next year. For now, we're going to list the headwinds and tailwinds we see for 2026, delving into more detail in the coming weeks here in our videos, as well as in person with our clients in January at our Market Outlook Summits. Investors, in the bulls camp, in very strong anticipated 2026 earnings and quarterly earnings growth rates. Currently, bottoms-up FactSet earnings forecasts have the fourth quarter of next year's earnings expected of about $82.50, up 17% year to year from the quarter we're in right now. Remember, investors, over long time frames, stocks follow earnings, and historically, unlike market bottoms that anticipate recoveries, the market doesn't historically peak in front of earnings, but rather coincidentally. Assuming no PE contraction in the S&P 500 in 2026, 17% growth on top of the current S&P 500 would triangulate to a much higher point in the second half of next year. Interesting, this path would also mirror the path we took along the dot-com AI investment cycle pattern post long-term capital in October of 1998 that stocks have been on in sync since the early April lows. A few factors that could contribute to these earnings numbers being achievable in 2026 are stronger than expected real GDP growth on the back of the elevated BBB incentive CapEx spending by large tech companies. Throw in a rebound in lower end and middle end consumer spending in the middle of the year due to larger tax refunds many spenders will receive in the big beautiful bill, and those are positive tailwinds. The bull market kicker that our team potentially sees happening in mid next year, a more dovish biased new Fed chairman appointed by the president that should begin his term or her term in early May, just in time if there is a seasonal weakness in the stock market. Can you say QE or maybe even yield curve control? Investors on the negative side of the ledger in the first half of 2026, things the market is likely to worry about, first and foremost, in our book, an uptick in market inflation expectations in the early months of the year seems to be likely. As we've discussed before, inflation is seasonal in the U.S. However, concerns over catch-up tariff effects, higher new year labor costs, and stratospheric medical cost increases could hit just as investors begin to worry about Fed independence under a new chairman next year. Investors, the Federal Reserve appears more fractured than we can remember, with the board members split between prioritizing waning job market strength or too higher than wanted inflation readings. Finally, like many other indicators, market volatility waxes and wanes in cycles. 2026 is the second year of a presidential cycle, the dreaded midterm election year. Investors historically, while posting positive returns, these midterm years have elevated levels of volatility and exaggerated seasonal swings in returns. Couple these negative headwinds with the increased scrutiny of what our team is calling the AI and economic credit circle, and the setup for a year of ups and downs of a bucking bull ride is higher in 2026 than many other years. The good news, our investment team has experience in these types of bucking bull markets. Remember that elevated volatility also means elevated opportunity for longer-term investors. Investors, historically, the biggest incremental returns you will receive come from investing when volatility is high, not low, and the markets are down, and others are acting emotionally, or worse yet, being forced to sell when they really should be pushing their chips into the center of the table and adding to their investments. So investors, what does all this mean to you in the new year? Our advice to you is to keep following our investment content on Oak Harvest website and our YouTube channels, and we'll be addressing many of these points and more in the future. Investors, tune in to our live stream on YouTube of our 2026 market outlook on January 29th, and whether you desire growth or income or a combination of both in your portfolio, the entire Oak Harvest team is here for our clients, doing what we can to plan for you and your family's future, regardless of what stage you're at in your career or in your retirement.